Andy Fenton.
Mr. Wynn, feeling like a little bit of PTSD almost.
How are you, my friend? We've got a fair few online. Give us a shout out, gang. Where are you? Who are you? In the comments. Love to hear from you. We're back. We're back, as Mortimer once said. We're back. And Wealth, Wine and Wisdom kicking off on the 3rd of March, 2021. Andy and I thought we'd have a little rest to save our livers. But the inaugural 2021 kickoff for Wealth, Wine and Wisdom. We're doing it midweek now. Fridays were a little bit hard to handle, but we thought we might keep the W's going. Wednesday, Wealth, Wine and Wisdom, 4 W's. As we have said many times, often more wine than wisdom, but sometimes, I think, Andy, sometimes we do get a little... Now, hey, Andy, is your name spelt right there? Because I think you've misspelt your name.
There might be a little bit of a slip there, mate. I know I'm dyslexic, but geez, I've missed the T, and I didn't even notice.
Well, that wasn't me. But folks, welcome. For those who are joining us for the first time, welcome. For those who are coming back from last year, we are now up to episode 38 of Wealth, Wine and Wisdom. It's now called Wednesday Wealth, Wine and Wisdom. How it first started, Andy and I are from 2 different industries, the property industry and the share and finance industry, the financial services industry, were serving and supporting our respective clients in the great toilet paper shortage of 2020, which was COVID. We got together every Friday because there was things happening in 2020 to help our clients stay safe, stay well, make good financial decisions. And it stuck. We enjoyed it. We had a few wines, sometimes a few too many. We shared some of our wisdom to help people, help investors keep their wealth. And I'm glad we did, because some interesting things have panned out over 2020, and we see some interesting things coming in 2021. Andy, I'll do the intros while everyone is listening. Myself, Jason Witten, over 20 years property investing experience and coaching property investors across Australia and New Zealand over 18 years. Andy Fenton, over 20 years experience in the banking and financial sector when it comes to financial planning, the banking world. And each Wednesday now, we get together, we chew the fat, share the wisdom, share the love with our respective communities to help everyone stay on track. So this is our inaugural kickoff for 2021. And Andy, great to be back with you, my friend.
And Andy, you, mate. It's a little bit weird to have a glass of wine on a Wednesday, but we thought we'd kick it off just for all of you out there who are concerned about our livers and our well-being. We're going to do the occasional one on the Friday, where we will actually indulge a little bit further into the wine and maybe bring a few great labels to you. But we thought, why not? We'll celebrate. We'll kick off what was a pretty incredible year. No matter whether you look at it as the pandemic year, for some people it was an incredibly good year. For some people it was a terrible year. So we thought we'd start off with a pandemic Pinot, and then try and give you some really meaty stuff over the coming end. For those of you who were a part of the original group when Jason and I first started this, we started off with a concept called the Seasons of Stimulus, and interestingly enough, we're about to hit the end of that season of stimulus. And so what's going to roll out is going to be just as interesting as what rolled in over that year. Although, here's the thing, we know that there is going to be a little bit less adjustment by governments, so we can predict a little bit better what is going to happen now, because we've sort of seen the unpredictable stuff to a degree play through.
Yeah.
So now we can look at how the world's going to put itself back together. And we've got some incredible insights and some incredible, resources that we're using to bring this to you. So looking forward to a year, hopefully a little bit more predictable than last. But having said that, Jace, we should bring back the segment of what we got right last year, because we made quite a few calls, especially you, mate, that landed really, really well. And I think that's a good little bridge into some of the segments that we've got here tonight, because for both of us in our relative markets, people were tearing shreds off equities, people were tearing shreds off property, and this is the end; it's never coming back. And mate, there was some pretty good opportunities that we brought to people's lives, whether they took them or not last year.
Yeah, mate, completely agree. While I do a little bit of adjusting at my end, Andy, maybe you can just adjust your feed to 720 or 540. We are getting a little bit of delay in your video. The old internet, it's great when it works and a bit annoying when it doesn't. But your audio is coming through fine. Your video is just a little bit laggy. So if you could adjust that as we go, that would be wonderful. But for those still on, we've got 35 on. Give us a shout out from where you're hailing today, gang. Andy's dialing in from Melbourne. You can see with his pasty white complexion there. He's a
It's the camera. It's the camera. I promise you, it's the camera. I was up playing golf with Jason on the weekend. Like, this is a tan for me. Have a look.
Yeah, he was up here in the Gold Coast having a weekend and getting a tan. But Melbourneite Andy. I'm from the GC or Queensland, and we got Bradley in from Mackay. Great to see you, Bradley. We got Lee in from WA, all the way from Western Australia. Great to have you on with us as well. Amy from Darwin. Awesome, fantastic. A few of the gang flying in here. There's Bradley, there's Lee, there's Amy. Great to have you guys on today. Alison, you're there. We've got Newcastle. We got somebody's driving a concrete truck. That's fantastic. Awesome. Great to hear you. Make sure you're watching where you're going, which is super cool. Well, that's awesome, guys. Well, listen, Andy and I wanted to let you guys know we wanted to put together a little bit of a process of the Wealth, Wine and Wisdom, how we're going to roll this year, 2021. And we wanted to sort of say we're going to do it in 3 parts. Each time we're going to get together. Wednesdays, we're thinking of doing the Wealth, Wine and Wisdom Wednesday, probably starting at about 4 o'clock to 4:30 at the moment, between 4 and 4:30 in Queensland time, which would be 5 o'clock or 5:30 in the southern eastern states, and Darwin and WA. I'm not quite sure what time that would be right now. However, it would be great to get your feedback, gang. 5 o'clock start maybe is probably a good idea. And what we're going to do is we're going to chuck it into 3 sections, or chunk it into 3 sections. What's in the news? We're going to break down stuff that's in the news, because things that is in the news in the world of shares, in the world of property, can be confusing. Often, my call is, I think 99% of it is rubbish, written by people who have no interest in owning assets and creating wealth through investing in shares or investing in property or investing in general. Sadly, it is about clickbait. It's about getting eyeballs, not about giving advice or being accurate. So we're going to break down what's in the news. We're going to do a section called Stuff You Should Know. As an investor of any description, there's things you should know, and Andy and I want to be able to maybe share some of our wisdom, our teachings from our experiences, stuff you should know right there. And then we want to do a section called Any Questions, which would be fantastic. And what we'd love to do, if any of you guys on right now would like to be the inaugural guest, fly in. We want to Zoom you in. Yeah, whoever's driving the concrete truck, we can't get you in. I don't think that would be appropriate. But whoever is up for it, who wants to be a guest, give us a shout out in the chat, and I might see if I can get you a link so you can zoom on in with us right now on our Ecamm Live, which is going live, and maybe be a guest for maybe 5 minutes or so to ask us some questions if you game. We won't do anything weird. It just might be a bit of fun to see if we can do that sort of stuff. So that's the thing we're going to do. What's in the news? Stuff you should know. Any questions? And maybe have a guest. Give us a shout out if anyone's keen to be a guest. But Andy, what is in the news for you, my friend? What is going on? Let's do what's in the news from Andy Fenton from the world of finance and shares. Give us the lowdown.
Well, mate, I thought I'd start off with this because, it's the low-hanging fruit, and I think it was the tone that we set last year, was that there's a lot of bullshit in the media, and as you said,
right.
Clickbait. And for those of you who don't know what clickbait means, clickbait for some of the less technologically advanced out there is it's just headlines that make you stop scrolling and clicking on whatever it is. And the reality is that, news used to be informative and now it's almost disinformative. And so and how do you capture headlines? Do I capture headlines by showing cute kittens and rabbits and things like that? Generally not, right? That's why it's at the end of the show. So the way that they capture headlines is by getting little dopamine hits and firing up your amygdala, which is the fear factory of the brain, and that moves you into action. And it doesn't surprise me, and this is a classic, what's actually written over here, is that we're literally just, we're almost at the peak of market for a number of years. Like the Australian equities market is teetering around some of the highs from almost going back to the GFC. We've got property, which has been, accelerating at a rapid rate of knots. So what they start to look at it and go, well, interest rates are staying low for a long period of time, and the Reserve Bank of Australia has come out and said, yes, we intend to leave rates on hold for quite some time into the future. And so all of a sudden, a pandemic, which I'm not going to say is, and my intention here is not to placate or is not to downplay the pandemic, but more to highlight the fact that when it comes to investing and when it comes to property, it's actually pretty good out there and nowhere near as bad as they made it out to be. So what is the headlines you're going to start to see? So here's me putting on my Nostradamus cap. I'm going to put that on here, and I'm going to start to predict that these monkeys are going to start to put, and I don't mean there's no racial connotation there. Monkeys, I just mean monkeys in general. They're, they jump around, they scratch their head, they eat peanuts, and they come up with bad headlines. And so this is the first one. Literally one day since they started admitting, oh my God, property markets are going really well. Oh my God, equity markets are actually bounced back really well. We've got nothing to talk about. So the big fear factor is then inflation. Right. And so here's how ridiculous these headlines are. And you can just Google it now, jump in and Google inflation. These are all 1 to 2 days old, which is no doubt they've got nothing negative to report on. So they're now, and for those of you who don't know, inflation is the average cost of consumer goods going up. So if that goes up aggressively, then in theory, the Reserve Bank should raise interest rates to counter that. And then the raising of interest rates should then have a bad flow-on effect to equity markets and to property markets, supposedly. So they're trying to create the new storm well ahead of the storm. The only thing that they didn't do, Jason, is they didn't actually, for more than a week, actually call it in the right direction, where they said markets are good for 1 week. And so that was the first time they got it right since, I don't know, definitely before February last year. So having a look at the effects of different types of market conditions, and this is sort of a general philosophy, if you will. So if we look at different types of market conditions, we've got prosperity that we call spring here, which is where you're heavily into growth assets, private equity, infrastructure, commodities, so on and so forth. But if we look at inflationary periods of time, which I'm not saying we're in, by the way, there is inflation and asset inflation in certain areas, but I'm not saying that we're in an inflationary period, not by any stretch of the imagination.
Yeah.
But what you do start to look at, you look at real assets, right? You start to look at real estate, and you start to look at food, farmland, and gold. which are all asset classes. But the one that they're trying, Jason, the one that they're trying, and I'm more of an equities guy, and I'm going to defend you guys at the moment. But the one that they're trying.
This is unusual. This is unusual. The equities guy giving a property a shout out.
But I'll only ever do it when I'm giving the politicians and the media a bit of a beat up. Is that they want to scare the living bejesus out of people now going into property. And the reality is that inflation is actually good for real assets, for real estate. So the headlines themselves are kind of counterproductive to the cause that they're trying to create. So I sort of thought that's interesting. And then when we have a look at interest rates being the lowest that they've ever been, when we have a look at everything that we can in as far as financial markets, who's been there before, we talked about it last year, basically exactly what we had to say came true. But, Japan has been there for a long time. And yes, it's had, inflation sort of spikes along the journey, but it's basically been a line game along the journey. So the very first shout out is what's in the news? Bullshit. It always is. But do the research, because they don't even know what they're talking about at the moment. But the other thing that is in the news, and I'll come back to that later on, in the news in my area, and again, this is going to actually play over to the property guys.
Yeah, I was going to ask about this one because we were talking about this the other day. This is fantastic, and pay attention, gang. This one's really interesting. I love it.
So there's this concept of a 60-40 portfolio. And in my world at the moment, and we were talking about this last year. So this is how late they've jumped on the wagon, right? So Jace, I think you and I were talking about this in April. The 60-40 portfolio is a portfolio that is made up of 60% of growth assets and about 40% of defensive assets. Defensive assets being government bonds, term deposits, and cash, right?
Yep.
Now, a couple of years ago, we'd be getting 4 or 5% for our government bonds, our term deposits, and a couple of percent for our cash. But as we know, that red line is what interest rates have done over in Australia over the last few years, and that red line is basically into zero territory. So you're getting paid nothing for your cash. So this was called a balanced portfolio.
Well, cash is trash, right? Cash is worth nothing right now. It's bloody bugger all.
The only reason you would hold substantial assets in cash right now is if you believe it's going to crash. All right. So you hold cash if you believe the market's going to crash, because at the moment you're not going to get paid anything for cash. And we'll talk about it in a different wine and wisdom when we get more technical and it's specific. But effectively, if you're in government bonds or long-dated government bonds, you have got unlimited downside risk with limited upside risk, which is almost nothing. So we've now got portfolios, and cop this. So let me put a fence to the listeners while I keep rabbiting on. And I want participation here from the chat. How much money do you believe is in superannuation right now in Australia? So just throw it in there. If it takes you more than 5 seconds to throw it in, we know that you're Googling. And we're not going to take it seriously, all right? Because we will give out awards from time to time.
Well, Andy, I do know where the delay is probably between 10 and 15 seconds in restreams. So, we might give everyone maybe 20 seconds. But Alison said she's going to volunteer as a tribute guest, the first guest off the rank. So, Alison, I've sent you a text message. You and I know each other. There we go. So if you see the text message, Alison, hopefully it goes to your mobile phone. It should be very easy for you to grab the mobile phone and pop on in. If your mobile's no good and you want it sent to your email, let me know. And we're seeing the comments come through now. Tony's saying 4 trillion, Andy. Bradley reckons 30 trillion. There's some big T's going on here. We've got some answers flowing on through.
So we'll keep you in suspense while I try and remember what the exact number is. But the second number I'm gonna throw out there, and I tongue in cheek, we know what it is. But the second number, as you're writing these down, is how much do you think in superannuation now is sitting in that 40%? How much do you think is sitting in cash? Or government bonds into that defensive sector? just have a little bit of a think and whack it in there. And I'll give you
So what was
a
the
tip.
question? How much is sitting in the defensive section in cash? So you're saying, all right, how much is in super in the whole Australian super? Tony reckons 4 trillion. Bradley reckons 30 trillion. And now what we're saying is, all right, how much is sitting in cash across accounts in Australia right now? Chuck it in the chat. If you're up for a number, chuck that number in there. Andy's got to pad this out a little bit so he can search the number up on his computer.
I've got it in here. So while you're all putting those numbers in, let's have a look at what I'm talking about here. So if you have a look across to this diagram, we've got shares and property. If it's 60% of $1 million portfolio, it's $600,000. Right?
Yeah.
Easy math. Average earning, around about 8% over time. That's kind of what property and shares and things like that tend to do with income and capital. So your reward for the 600,000 is about $48,000. Then you've got your fixed interest or your defensive part. So that's the 40%. So that's 400,000. So you had around about 5% you used to be able to get for this. So that's about 20,000, which means that your 60-40 portfolio over time is probably going to give you about $68,000 to the million, which is 6.8%. And many of you will have seen those types of returns bandied around for a while. Here's the challenge, though. When that 400,000 drops to a 1% and now below 1%, well, all of a sudden that 68,000 starts to diminish pretty quickly. And that $400,000 that you've got in is earning you $4,000 at 1%. $4,000. So you've got to start to think.
It's ludicrous.
It's crazy. It's absolutely crazy. And when we take into consideration inflation, which could be running at 2%, then your money's actually back.
Yeah. Well, but pay the tax on that as well. I mean, what are you going to pay 30% tax on it if across maybe 20%
15% tax when it's in super. So yeah, exactly right. So people are asking themselves, quite rightly so, and investment managers are asking themselves, well, is 60-40 dead? And it's a great question because at the moment you're not holding cash for any type of interest rate whatsoever. You can't hold it for capital growth because you're going to get very little or none. But you could suffer a capital loss if interest rates go back up. So there's a lot of forces that are pushing interest rates back down. So if we have a look at, actually I won't go through these, but the question is the 60-40 portfolio dead?
I reckon it is. It's dead, Andy. It's dead.
So of that, and look, at the moment, we're asking the same question for our clients, and we're trying to find those real assets or assets that have a more defensive character than just bonds. So here's the story. Clients, and this one, Jace, are sitting there going, well, I've got $2 million in my super fund. I've got, the moment 800,000 or so sitting in cash and term deposits, which used to give me 5%, which was great, but now I don't have any. And they say, well, Andy, given the fact that we can't get that there, I want to invest in blank. What do you reckon it is? So when you get this, just quickly type it in there. I want to invest in blank. What do you think is their next most defensive asset class?
They're not typing in blank, right? They're typing in what they think, right?
So that would be awesome, wouldn't it? A feed of blank, 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 blank.
All right, so type in what is a defensive. What's the next defense after bonds, cash? What are the other two? What were the other classic defensive assets, Andy? Is there any others? Just bonds and cash?
Well, there's creative ones that are high. So term deposits, bonds, cash, and then bonds go into corporate bonds, junk bonds, but then they start to become very risky.
Junk bonds are rubbish, mate. Junk bonds caused the GFC, Andy. Don't fucking talk about junk bonds.
Wankers caused the GFC. Sorry.
That is banker wankers, by the way. Reform banker over there. Don't worry, I live on the Gold Coast and I'm in real estate. I don't have white shoes or a gold necklace, so hopefully I should be okay. All right. Well, Tony reckons bonds, but Tony, what we're saying is if bonds and cash are off the table because they're both rubbish right now, what's the next defensive asset people are thinking about? And Andy, I reckon you just dive right in there.
So, and this isn't me saying it, by the way, this is what we're seeing, because we're seeing, let me just contextualize it a little bit more so you guys can put some more comments in to let us know what your thoughts are. But you've got retirees or pensioners, right, that are used to having a portfolio that isn't 60-40, right? It's this. It's the 70-30. So 30% is in aggressive assets, 70% is in bonds and cash.
Yes.
Right?
Yes.
So just to clarify that, that's $700,000 of $1 million portfolio would normally have been sitting in term deposits or government bonds. So if they're sitting in there, well, they're asking, where do I put my 40%? Where do I put my defensive play? And here it is. So just for all of you, it's $2.9 trillion that's actually sitting in the superannuation environment right here, right now in Australia.
Tony was pretty close. Tony was pretty close. Tony said 4 trillion. So it's 2.9 trillion, Tony.
2.9 trillion as at December 2020. 791 billion. That's for billion. $791 billion, right? That is looking for a home. And I use that play on words because that's what we're seeing. We're seeing people say, Andy, term deposits don't work. Andy, government bonds, crap. We need a yield. We've got 70% of our assets in this asset class that's not giving us any return. Well, the next most expensive asset that we know is property. So let's buy property because we can get 5% rent. And that is, I'm not saying that that's the way that it should be. I'm not saying that that's the way that people should be looking at it. But what I'm telling you is that that is what we're seeing. That's what we're seeing people do.
Yep.
Now, if you've got $791 billion, and even you just said, well, you know what, it's a quarter of that that's trying to find its home in, you're still looking at $200 billion that's going to be filtering out into these real assets. Now, we're looking at things like commercial property. We're looking at things like infrastructure. We're looking at other, vehicles that can be syndicated and potentially in our world create more defense. And also in our world, you can have smaller clips of it because you can get in 25 grand, into syndications rather than 750 grand into property. But what I'm telling you and what I'm seeing in the market is that 791 billion is starting to move, and people are starting to become more aggressive, because if you don't believe the market is going to crash, people are looking for a yield, and that 791 billion is looking for a home, Jace.
Mate, that's a perfect segue into where I'm at, what's in the news, what's going on, because we're seeing that right now. And Alison's in the green room. She's waiting. So Alison will probably get to you as a guest in maybe 5 to 10 minutes. So thank you for joining us. If you've got a question, it would be lovely if you had a question. If not, it'd be just lovely to see your face and fly you in as a guest, as a bit of a test case, the first guest off the rank for 2021. But what's in the news for the real estate game, Andy? I'm just going to quickly do a little bit of a history lesson right now. What was in the news? This was reported 13th of May. CBA warns Australian property prices are going to crash 32%. What a bunch of rubbish. I said rubbish at the same time. Back then, I don't know where these people get their information from. It's certainly inaccurate. And you and I have joked about this 100 times, Andy. What's the only job you can be wrong all the time in and still be employed? Being an economist. And they never get it right, and they still get jobs, and they still get paid really well. So that's a pretty interesting one. But anyway, they were wrong. I knew they were going to be wrong because there was some actual facts and evidence in the marketplace that was counter to that one, which is interesting. Weatherman maybe forecasting. Well, I certainly can't forecast the future, but I can certainly tell when someone says something in the real estate game, whether that's going to play out or not. And what we do know right now, Westpac, as of right now, February 2022, 2021, is saying, hey, it's going to go up 20%. How does our fortune turn 50%, Andy Fenton, in 13 months in the game of real estate, according to the banks of Australia? It doesn't. It's bullshit. Both comments are rubbish. The reality is it never fell anywhere near the amount that the CommBank was warning about. And to be honest, hardly any pressure was on prices across Australia. It was psychological, emotional pressure. And thankfully, Andy, people tuned in to your and my information on Wealth, Wine and Wisdom and other ways we supported our communities, and we helped them stay on track. Because here is the facts right now in the Australian marketplace. Vacancy rates, which are a predictor of the supply in our real estate market, where you can see right now across Australia, you can see from Brisbane, Perth, Adelaide, Canberra, Darwin, Hobart, those marketplaces are under 2%. Under 2%. And you can see from Perth down is under 1%. That is severe, and I mean severe, supply shortage in our marketplace. If you go and check out my Facebook Live in June 2019, you can track it down on my Facebook page or our Positive Facebook page. I said in that live, ladies and gentlemen, we are entering the largest, the worst undersupply we have ever seen. It is on its way. And Corona made it worse. It didn't cause it. It just made it worse. And now we are in the most severe undersupply new construction undersupply Australia has ever seen in its history. And the only saving grace right now, why we aren't having, absolute madness and mayhem occur, is that our population immigration numbers have fallen to soften the problem that we are facing right now. And I can tell you right now, very soon, the borders will be open and people will come to Australia within a year or two, and this problem will not be solved in that period of time. There's a 3 to 5 year transition time frame between this problem and the solution. And we're going to have some interesting times. It certainly won't be any property prices falling anytime soon. I can tell you that one. Property prices are going spastic. As far as I'm concerned, I believe not every property will go up 20%. That is a rubbish comment as well. That's rubbish comment as well. Some properties did go down in value. Some properties went up in value. Some properties won't go up in value in the next 2 years or 12 months. That is a quality conversation. We can talk about that another time. You can see places like Melbourne and Sydney have slightly declined in vacancy rate. But one thing I do want to point out with this one, Andy, is the devil is in the details in this one. If you have a look in here, if you draw a line across there, that is all Melbourne.
Zoom in a little bit for me there, mates, just so I can see the numbers there.
Yep.
Yeah, perfect.
Okay, so what does that show? That shows the rise in listings in locations and the drops in rents as a percentage in those locations. Okay? Now, and the reason for that, which is predominantly focused in Melbourne, a little bit in Sydney, and a smidgen in Brisbane, very, very small locations in Brisbane, is because, ladies and gents, the devil is in the detail. That is university located accommodation. 50% of this vacancy up here is university students not getting access to Australia. That will change, and that will change overnight in a very short period of time. All right, I'll skip that part. Another fact in the news right now in Australia, it is cheaper today from a cost and affordability point of view, lowest interest rates to purchase a property than it was 11 years ago. And what has happened is that the people who have been priced out of the market in this section of the market over about a 5, 7, 8-year period are back with a vengeance right now. So what Andy is saying, we've got $7.9 billion, $791 billion looking for a home, which is, let's invest in a defensive asset. So too are the millennials who didn't buy a home, but now interest rates are so low, it is cheaper to buy a home in most capital cities than it is to rent a home in most capital cities. And the government created a stimulation that was off the charts when it came to first home buyers. They were giving money away like drunken sailors, as my business partner, Sammy Saggers, says. And it was close to $50,000 of cash and incentives for first home buyers. Okay, so what we've seen, Andy mentioned it before, 3-year bond interest rates down to absolute insane lows as we go. But here's the drill, gang. Our change in dwelling, our stock supply, and our change in population, it has plummeted insanely down to record lows. And you watch when our population bounces from the bottom, which has been restricted. Population changes or immigration will change faster than construction in Australia. Okay. And already the government is saying, you know what? We're going to allow people in with money. And when we get a chance, we're going to do that. Building approvals. So what happens is construction, dwelling stock, the amount of properties that are alive today available, and then approvals. Approvals are a 3 to 5 year window into what is coming potentially. We have seen some significant drops across houses and across units and apartments and townhouses in the property market. So, Andy, that's what's in the news in my neck of the woods. What is in the news for the next 12 months, and I think we'll see it play out, is this significant shortage in new properties, which will put all sorts of knock-on pressure and impetus on property prices increasing and also rents increasing. Because this is a weird one. For the first time in 22 years I've been in the world of investing, Andy, when interest rates go down, the pressure often is off the rents going up. And we saw it actually for about 2 years. Interest rates go down and rents actually soften for the first time in a long time.
Yes.
What is going to happen right now is actually interest rates will stay low, if not maybe even go down a smidgen from the banks, not from the RBA. But you will see rents go up because the supply is so constrained. Landlords will be able to put their rents up while keeping their interest rates low. And that is the first time I have ever seen that. Well, first time I've seen it in my 22 years of investing in real estate. It's a new world in that sort of space. So that's what's in the news for me. And mate, Interesting times when it comes to both of our worlds. That is for sure. That is for sure. But we've got.
And look, I think that's a really good, just before we throw to the guests, I think it's a really good summary, and it's a great way to start off Wine and Wisdom for this year, because it's a great example. And you and I often have different thoughts from property to equities, but one thing that we're very, very vigilant on is where we get our data from.
Yes.
And it's a matter of, you've always got to look at the other side. Don't just look at a couple of headline statistics like Melbourne's occupancy rate is high. You've got to understand the reasons why, and you've got to delve a little bit deeper. So I think between what we've gone through today is the sort of value that we'll try and bring throughout the rest of the year is that, okay, there's a headline. Is it true? Yes, the headline's true. Is it bullshit? Yes, it's bullshit. And why is it bullshit? It's because it's the headline with the headline number, but here's all of the data that sits underneath that number. And what we're not saying is don't go out and buy property. We're not saying go out and buy property, because that's what Jace's business is for, and selecting right assets. And that's what my business is for, as far as getting the right mix of things right. That's what we are saying, is make sure that you're making wise decisions with your money, not something that is spurred by whatever you're listening to in the news. Because if you did, you would have sold your house in the pandemic, and you would have sold your whole portfolio of shares in the pandemic, because the world was going to end. Yeah. If you did that right about now, you'd be very, very, very unhappy that you did.
You'd be kicking yourself. You're dead right. And then the cost to get back in, Andy, the cost to get out, the cost to get back in is where people lose out long term, where investors lose out long term. And to be honest, someone who buys and sells based on the emotions in the market are not investors. And if this is you, then it's harsh, but it's true. You're a good time Charlie, and you are the person who causes the problems. So listen, go to the casino, don't be an investor, because you give the rest of us the shits because you can't go the distance when it comes to investing. Investing is for a long time. You buy an asset and you own it and keep it, right? Anyway, there's my little rant. There's my little moment on my soapbox anyway for today. But what I'd love to do, Andy, so gang, we've done what's in the news. We don't have time for stuff you should know, but we are going to have that segment, stuff you should know, coming in the very near future. But today, stuff, other way, Andy, other way now. For right now, we would love to bring in a guest. Alison, if you're ready, we're going to fly you in here, hopefully. There you are.
Guys.
There you are. You're looking awesome. Great to have you here today. Now, I think maybe the internet might be a bit weird and funky. Maybe if it's even at my end. But anyway, how you been?
Good, thanks, Jason.
So, do you have a question for us today? You're a friendly guest, which is good. What question do you have for me or Andy? It doesn't matter. Chuck it out there.
Just a general one. I just saw, actually, speaking of what's in the news, that Brisbane is a contender for the 2023 Olympics. Just want to know, if that goes ahead and that happens, what are your thoughts on how it's going to affect the market, especially the property market and tourism in general?
Yeah, well, Andy, I know you'd have plenty to say about this one. Why don't you kick it off and I'll sort of round it out?
Look, it's a short-term effect as far as the money influx into Australia and the tourism, but it can mean big things for business. It's quite often the infrastructure side of the equation that becomes the very, very big strategic advantage for the state, because they get almost a limitless check to go out there and put good resources into the logistical operation of a state. And when they use that money wisely, then the whole areas can become more efficient, can use that infrastructure for other events moving forward, for lifestyle, for business, so on and so forth. So effectively, the state gets a free kick, and all other things being equal, if they spend the money well, then that can provide substantial benefits moving forward. A lot of people kind of think that it provides a good short-term arbitrage or to get into the market. I'm not a big player into that. I think that probably there can be a bit of a timing effect in it. But if they do win it and they do spend the money really well, then if you're in the flight path of the infrastructure that gets put in place on a property perspective, then you could do really well. If you're a retailer or a business that is making its crumbs from people on the ground, then it's obviously great, and it'll boost up the overall revenue coming into the state just from overseas travellers, assuming that overseas travellers can actually come.
Well, I think it's a few years away, Andy. My question, to sort of dovetail into Alison's, is there any correlation? Have you seen any correlation in the most recent time obviously is the Sydney Olympics. Were you do you have any feedback or commentary in and around that time in the marketplace from your world, the shares and equities world? Was there any sort of Australian correlation for value?
As far as what was going on in the state and how it impacted, well, it impacted businesses in an extraordinarily positive way. My thoughts logistically on what they did as far as the stadiums and so on and so forth, I think that they probably made a bit of a meal of some of the positions of some of the stadiums because they turned into ghost towns. And this is what I'm alluding to, is if you make good strategic decisions and they're long term, they're not just for the Olympics, they're strategic decisions about the infrastructure of the state, and you can do some incredible things. Sydney, I think by the nature of Sydney being Sydney and how built out it is, it had to put a lot of it out into the far distant suburbs, and it became a bit of a logistical nightmare. And so you ended up with ghost villages. Which really didn't give them a lot of long-term bang for their buck. They're only just starting to use that infrastructure now in a productive way.
Yep. Yeah, it's certainly the case. Certainly from a real estate point of view, Sydney in the past, the experience absolutely went ballistic after the Sydney Olympics. There was a direct correlation with the amount of visitors, the amount of overseas exposure that created. I believe that Brisbane is yet to feel that international flavour yet. Melbourne and Sydney have been on the radar from the rest of the world for a long, long time, and I believe that Brisbane, this is going to be a chance. If it wins, this will be a chance. Sam, and probably not Sam has said it, but I think it comes from other places where Brisbane is a new world city. It's small, it's compact, it's new. Melbourne and Sydney are a bit more old world. They've got large populations. The capacity for infrastructure and improvement is restricted because of the population and the cost of its real estate. So my call, Alison, will be that I think if Brisbane wins this thing, I think we're going to see a significant, increase in the attention on the real estate of Brisbane, and that will certainly bring some value increases for good quality, good positioned real estate around the world. So. Mate, good question. I think it's exciting. Certainly, I do know the property that you are in, and I would be very confident. I'd be very confident in the that property receiving excellent attention from winning the Olympics because of its connectivity and its style of real estate. That's for sure. I think. Yeah. I think you're in the driver's seat with that one, buddy. For sure. Yeah.
No worries.
Nice. Awesome.
Thanks, guys.
Well, fantastic to have you on. Thank you for being a guest and being our first inaugural guest. Thank you very much, Alison, and have a good one. We'll let you go. Thanks, Alison.
Will do. Bye.
See you. Now, Jason, you didn't set us up with that because that played beautifully into the property game there. Didn't give the chairman as much to talk about, but certainly lit your tyres on fire. I'm going to have to bet these coming through in the future, I think.
I think you need to load up a guest or two in your neck of the woods, mate. Fly one in. Well, I think the timing's right, mate, for us to call it a day on our first inaugural Wealth, Wine and Wisdom. Mate, fantastic to chat with you. Can you tell your hamsters? Can you tell your hamsters next time to pedal a bit faster? The internet was a bit slow for you down your neck of the woods this week, but next time, hopefully, the hamsters are going a bit faster.
I'll get there, but I tell you what, the old NBN, the old bullshit down here, mate. I moved to America, and then I'll stream in from there, and that we might be going. But I'll certainly get the old copper cable round around the biscuit and getting that sucker.
Mate, I think you got to get on the 5G, mate. The 5G's the goods, but mate, fantastic to catch up with you again, my friend. Hopefully everyone has enjoyed the first kickoff for Wealth, Wine and Wisdom. Just again, showing you guys what we're going to be covering, what we're going to be doing. We're going to be doing what's in the news, stuff you should know, any questions. And as always, my world of property, Andy's world of equities and shares and the share market. We wouldn't call it a clash, but we'll call it a rubbing up against. We have a good, robust conversation about our two worlds and how we can navigate them as property investors, as share investors, as people who want to take care of our money, because at the end of the day, that's important for us all to make sure we take care of our wealth. But thanks for dialing in, gang. Sharon's there, Alison. Thanks, guys. Really appreciate you guys being in. This one, Hardik, this one will be loaded up live to the Positive Mentor YouTube page. We'll let all the mentoring clients know and as we go along. So really awesome to see you guys on today. Thank you for joining us. We're going to kick this off. It's going to be 5 o'clock Sydney, Melbourne time, 4 o'clock Queensland time or thereabouts. Each time we're going to talk about what's going on in our world. So appreciate you guys joining us. Andy.
Mate, till next Wednesday. Good day, good night, good tomorrow, mate.
Thanks, Lee. Thanks, gang. Bye-bye.